Saving $50,000 is a massive financial milestone, but the moment you hit it, a new anxiety sets in. How do you deploy that money over the next 2 decades so it actually grows? If you listen to financial advice online, you're usually pushed into one of two polarized camps: buy a physical asset like real estate, or put the money to work in the background with index funds. This matrix shows our starting line. Let's look at the real estate route first. You take that $50,000 and use it as a 20% down payment on a $250,000 rental home, taking out a 30-year mortgage at a 7% interest rate. Alternatively, you take the exact same $50,000 and put it into a broad total stock market index fund. Because there are no home repairs to save for, you also set up an automatic investment of $200 every single month. On day one, the real estate investment feels like the clear winner. You have a physical building you can point to, and a tenant paying rent. The index fund is just a number changing on a screen inside an app. To find out which strategy actually builds more wealth, we are going to run both investments side by side on an exact 20-year timeline. Over the next 2 decades, the math reveals a reality that looks nothing like the quick wealth stories shared on social media. For the first 3 years, the real estate strategy looks brilliant. The tenant pays $1,800 at the start of every month, and every mortgage payment steadily chips away at the loan. If you run the basic math of rent minus the mortgage payment, it looks like you've generated nearly $17,000 in positive cash flow. Meanwhile, the stock investor has a much quieter experience. There are no tenants thanking them, just small, unpredictable daily fluctuations in a brokerage account. But assuming the market delivers its historical average return of 10%, that initial $50,000 plus the $200 monthly drip has grown to roughly $76,000. The rental property has also increased in value. Between the rising local housing market and the steady mortgage paydown, the owner's total equity now sits between $80,000 and $85,000. This early lead for real estate comes down to leverage. By putting down $50,000, the investor controls a $250,000 asset, allowing them to capture the full appreciation of the total property value. Stock investors simply cannot replicate this type of wealth multiplier without taking out dangerous margin loans. Leverage gives the physical property an undisputed early advantage. It makes the wealth feel substantial, but it also hides the steady labor required to keep that asset functioning. That $17,000 in positive cash flow only exists on paper. The monthly rent check is where the math begins, not where it ends. This scorecard deducts hidden costs. First, budget 1 month of zero income annually for vacancy. Next, budget 1 to 2% of the property's value yearly for maintenance. Finally, major repairs like a broken roof instantly wipe out thousands of dollars of profit. Finally, someone has to manage the property. You can hire a professional and hand over 8 to 10% of your monthly rent, or you can manage it yourself and pay with your personal time. Doing it yourself means answering late-night phone calls from locked-out tenants, scheduling contractors during your lunch break, and spending your weekends fixing leaking sinks. While online influencers often claim 15% returns, the actual cash-on-cash return for this property, once every genuine expense is included, has settled closer to 3%.
Managing the property effectively creates a second job, requiring consistent, active involvement to protect the investment. By year 10, the stock investor's journey still looks incredibly boring. They have done nothing but add $200 to their account every month without interruption. This chart tracks the stock portfolio's growth over time. At a certain point, the curve bends upward. The portfolio's annual growth begins generating more money than the investor's actual out-of-pocket contributions. The portfolio has reached roughly $175,000. They haven't answered a single phone call or fixed a single appliance to get there. The real estate investor holds roughly $180,000 in equity at year 10, but over that decade, they've spent roughly $30,000 out of pocket on taxes, insurance, and maintenance. The underlying risk of each strategy has also become clear. The real estate investor is carrying hundreds of thousands of dollars in debt, with their entire investment tied to a single physical structure in one specific neighborhood. The stock market investor operates entirely debt-free. Their money is broadly diversified across thousands of companies in the economy, and they can sell their shares almost instantly if they need cash. At the halfway mark, both investors have reached near identical financial standing. The major difference between them isn't the dollar amount, but the specific risks and liquidity they accepted to build it. Another 10 years pass. When we look at the full 20-year picture, we finally see the complete net worth of both wealth engines. This table shows the final tally. Adding appreciation, loan paydown, and net cash flow, the real estate investor finishes with roughly $505,000. The index fund investor, operating without debt or tenants, compounded to approximately $518,000. But to secure that $518,000, the stock investor had to pay a different kind of price, surviving terrifying market volatility without hitting the panic button and selling. During the 2008 financial crisis, or the early months of 2020, standard index funds plunged by 30 to 40% in a matter of weeks. Watching decades of savings evaporate on paper is psychologically brutal. The stock market spares you from weekend repairs and tenant disputes, but it extracts its toll by demanding intense psychological endurance during severe economic drops. Over 2 full decades, neither strategy completely outclassed the other. They simply took 2 vastly different paths to reach the exact same $500,000 destination. This flowchart maps out the decision. If you want tangible control, monthly cash flow, and are willing to trade free time for leverage, real estate is the choice. If you value your weekends, prefer passive compounding, and can ignore market crashes, stocks are superior. There is one final trade-off to consider. A $500,000 stock portfolio generates very little actual monthly income compared to a fully paid-off rental house, making it much harder to replace a monthly paycheck. When investors argue over which asset class is superior, they usually fail to account for the invisible price tags attached to each: the time, the stress, and the risk. Ultimately, your strategy depends on which specific costs, the physical work of managing property, or the mental strain of market volatility, you find more tolerable over a 20-year journey.